Let me guess, you've been taught that all debt is bad and that the goal is to pay it off as soon as possible, right? Well, what if I told you that some debt could actually work for you? That's what debt conversion is all about. And today, I'm going to break it down in plain language. No jargon, no spreadsheets, just real world examples and tools that you can actually use. Hey, I'm Erica V, mortgage strategist, real estate investor, and somebody who's been helping Canadians think differently and how they can use their mortgage to build real financial freedom. And today we're talking about a concept that's central to the Smith Maneuver, but it's also powerful even outside of it: debt conversion. Because if you're still throwing extra money at your mortgage every month without a strategy, you might be missing out on one of the most powerful financial tools available to Canadian homeowners. Now, at its core, debt conversion means taking non-deductible debt like your mortgage, like traditional mortgage, and converting it to a tax-deductible debt. Why, you ask? Because when interest becomes tax-deductible, you're not just paying the bank. You're getting a portion of that money back in the form of tax savings. Now, in Canada, the interest on your mortgage is not tax deductible, but the interest on borrowed funds used to invest, that is tax deductible. So for our purpose, debt conversion is the process of gradually shifting your expensive mortgage debt into an investment debt and making your money work harder for you in the process. Let's walk you through a very simple example. Say you have a readvanceable mortgage. That's the kind that gives you a line of credit that grows every single time you make a mortgage payment. Now, every month you make your mortgage payment and a portion goes towards principal. Now, the principal reduction becomes available to you again through your line of credit. And instead of letting it just sit there, you reborrow it and invest it. Now, I'm not giving financial advice, but you're going to have to invest it in some sort of dividend paying ETF or an index fund, or an income-producing real estate asset. That borrowed money is now tied to an investment, which means the interest on it becomes, you guessed it, tax deductible. So over time, you're converting your mortgage debt into investment debt without increasing your monthly out-of-pocket costs. Now, until recently, most Canadians have avoided debt conversion because, well, it sounds pretty complicated. Maybe it sounds risky, or they just assumed it was for the ultra wealthy. But the truth is, debt conversion is just a strategy. And when done properly with the right setup, structure, and of course, guidance, it's actually one of the most stable ways to build wealth in Canada. You're not adding new payments. You're basically keeping your risk tolerance at the exact same place it is currently, and you're simply making your existing payments do more. And for many people, the tax savings alone are worth it. But here's the bigger picture. You're already paying your mortgage. You're already building equity. But if you're not leveraging that equity through a smart strategy like debt conversion, you might be leaving an opportunity on the table. This is how everyday Canadian homeowners, not just investors, start building portfolios, creating cash flow, and finally stop feeling like they're always behind. So if you've ever felt like your mortgage is just a huge monthly payment that doesn't give anything back, debt conversion might just be your perfect next move. And that's what I'm here for. Book a call, let's build your plan, and let's turn your mortgage into a strategy that actually supports your future. And don't forget to subscribe. We've got more videos coming that break this all down even further with real world examples and simple walkthroughs. Mortgage Free with Erica V.